Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast. If you're new here, we share our experiences so you can have the confidence in making informed decisions.
And today we're going to be talking about the risks involved in property investing. And Damo, how about you kick us off?
All right.
General market risk.
All right, Jez. So general market risk. So this is pretty much, I guess, for anyone looking to invest in property, it's any external market factors. So I think the big one at the moment would be interest rates over the last sort of 6 to 12 months. The impact that it's obviously had on property values and cash flows.
Yeah, it's stuff like recessions, pandemics, wars. They're out of an investor's control. But humans will always need a roof over their head. So not all is lost. Investors just need to be prepared to weather those kind of storms.
Yeah, it's also interesting to see with these high interest rates, like the markets are picking up at the moment due to the lack of supply in a lot of the markets out there. So I think, the really important thing here with interest rates to mitigate any type of risk is having those cash buffers in place. So 6 to 12 months or whatever you're comfortable with. And if you are, I guess, on a higher risk scale from clients I've seen in the past, if you like to only have a couple months worth, you need to make sure your job security is there, which is really crucial. And also potentially someone close to you, a family or friend that you can lean on if you didn't have, you've got access to liquidity or cash. Because if you lose your job, and you've only got 1 or 2 months, and these, can have a big impact.
Yeah, and I think that point you raised about 6 to 12 months is important because people need to realise that these sorts of storms are not forever. They do pass. So you just need to be ready for when they come. All right, what about location risk?
Yeah, so I guess location risk is pretty much depending on the area that you're investing in. And I think the key thing here is use the DSR to shortlist your suburbs. So, if you're looking at, depending on what your price point is, let's say 550,000, and you're looking for a specific yield, you really want to go into these markets that are seeing that upswing in DSR. And the way that I'd look at it is that local government area, shortlist my suburbs that I'm after, and then, other things like, using maps, getting on the ground to do a bit more of that fundamental research on the ground, but start with the DSR. What do you think?
Yeah, and the DSR is going to give you, you're going to hit the ground running with some capital growth because demand exceeds supply. But over the long term, I think securing or avoiding the risk of oversupply is relatively easy because all you have to do is buy a house in a built-up area, and that is very simple sort of research to do.
Yeah, and the other thing you can do there also is, like I said, you do your research, you can take it to that SA level also, and just make sure that stock on market is tight across all these areas. And if there is markets with a high stock on market percentage, you can do a bit more investigating. You not generally see it with, I'd say, units.
Yeah. All right, legislative risk.
Yeah, so I'll start with, let's say, federal. So it could be, with negative gearing benefits abolished. It could happen one day. So I'd say that's definitely a risk. You've got state. So it could be rent control or maybe changes to stamp duty. So you can always check, I guess, state revenue websites just to keep an eye on that. And then councils, so local zonings and building regulations. So if any new units are potentially going up. Yeah,
it's interesting. The Labor government proposed to abolish negative gearing a few elections ago and managed to lose the unlosable election. And it has been removed in the past and reintroduced relatively quickly. So it seems unlikely that will change, but you never know what crazy ideas the government will do, or the opposition for that matter, to win uneducated votes. Yep. I'm thinking more along the lines, super is more likely to undergo reform, and property investing is actually a hedge against the risk of changes to superannuation. But another thing on that state rent control, which has got under my bonnet recently. I've just seen a lot of opportunistic kudos grabbing PR exercises from state governments. And to me, it's just pure vote garnering. I mean, you've got almost as many landlords as you do to tenants, and we all vote. So it just seems a little silly to me, and certainly it's not enticing more investors into the market, which is what you want when you're short on supply. Anyway, so there's some things you can do to mitigate risk. Check the council zoning, and like Damo said earlier, have cash buffers in place. All right, let's talk about area economic risk.
Yeah, so this is pretty much, I guess, the health and stability of a market. And how it can effectively, I guess, affect the value of the market. So areas with maybe strong job markets, diverse industries, a growing economy tend to sort of have that lower location risk, where properties in regions, I guess, with high unemployment or economic decline, might be at sort of that higher risk. So maybe isolated mining towns potentially.
I don't think you have to buy in the big smoke, but you just want to avoid those genuinely remote areas with, in particular, like a single industry, like you said, the mining town. And by the way, I mean, state capital cities are not immune. Like Perth, for example, around 2015, that took a big kick in the groin when the resources sector nosedived. Prices went backwards by about 20% for about 5 years there. But, if you keep your finger on the pulse of the data, you keep an eye on the demand to supply ratio, you'll have plenty of warning time anyway. So, big markets move slowly.
Yeah, and really interesting there. I remember I had a client, maybe about 4 years ago, 3 properties in Perth, and he held them. He had 6-7 years. He acquired these 3 properties, and he didn't acquire the properties from any equity gain from any of those assets. He worked hard, earned a good income, and funded all these deposits with cash. And he came to me and he's like, well, I read these books and they say property should double every 7 to 10 years, or roughly about that mark, and 10 years, let's just say. And he was just saying, like, why aren't they growing?
Yeah.
And he invested pretty much these 3 properties maybe within half an hour of each other. So he didn't have any of growth through that period. So we did a seller hold analysis on several of those properties. One of them he had on the market, and there was another one that I recommended that he should have sold at the time, which he did. And so, it's just really interesting. You got to be aware that having all your properties in one area can be a risk, but at the same time, it can work really well if the market does pick up.
Yeah. And I guess as long as you hold for long enough, I mean, holding a property over the long term covers over a multitude of ineptitude. But if you don't have time on your side, then you definitely need to make a good decision up front.
Well, that could be a bit of diversification risk there, you know what I mean? Like, could have bought one in Perth, maybe one in Adelaide, maybe one in Brisbane, and then it would have been sort of spread out instead of having that risk of having it all in that sort of one pocket.
Too many eggs in one basket.
Yeah.
All right. What about supply and demand dynamics?
Yeah, interesting. So obviously with the demand to supply ratio, we can assess if markets are undersupplied or oversupplied. So things like, as I mentioned, like shortlisting suburbs via the demand to supply ratio is key. So, keeping an eye on things like greenfield estates is a big one. So, if you're looking in a specific pocket, you can use like Google Maps, DAs. You can drive. You can ask, like with the greenfield estates, you can potentially talk to, I guess, developers on how much supply is going to come on. But you can get that from the council either way.
Yeah, and over the long term, I mean, protecting against oversupply over the long term is fairly easy, because all you're doing is buying a house in a built-up area, because you can't have more houses. Houses require a lot of vacant land. So if you just steer clear of vast tracts of vacant land over the long term, you should be fine.
Yeah, and I think back to that point, like for example, if you're looking at investing in a region, and let's say you look at all the markets there, you've got every suburb there, you can look at the stock on market for all these areas, and you tend to normally see the stock on market percentage is going to be higher for those suburbs that are pretty much brand new, i.e. greenfield estates. But not to say that all of them are bad. We just see it as sort of higher risk. So I know there was a suburb, again, clients back in the day in Tarneit in Victoria, and also north near Donnybrook, just farmland. Developers 10 plus different developers, land and house packages. There was nothing there. So I would see that as significant risk.
Yeah, that's the stereotypical must avoid.
Yeah.
Yeah.
But if you go to another area, because again, people become emotional, they buy this, a house for themselves, build, they like brand new. There is sort of potentially new infrastructure in those areas also. So you just need to be aware. If let's just say we use Lend Lease as an example, they got a development, it's going to be over 20 years, but let's say they're only releasing 200 blocks going through the council, let's say every 6 months. 1,000 people are registered for these blocks, or 10,000. Let's say 10,000 people
Wow.
register for these blocks, but they're only releasing 200 every 6 months. You know that stock's going to get absorbed, and you're going to see a very big increase in values over that time. So again, it's just a risk mitigation, but keep an eye on that stock on market percentage
yeah.
number for any oversupply.
All right. What about new infrastructure? So after you've purchased a property, there's some infrastructure that pops up which could be a risk.
I guess risk. I guess if it risk for me would be like, let's say you buy maybe potentially near a highway and they extend it. So let's just say Bruce Highway as an example. I know there was a client in the past that used a buyer's agent, and they purchased not far from that highway, and it actually got extended. So could with a rise in noise potentially and traffic. I think that property ended up being sold afterwards, but there was some capital gain in that asset. But it's just a risk if you sort of go close to these highways potentially that they extend it or make it wider.
Yeah, that's a good example of infrastructure negatively affecting your investment. I was thinking of one study that I saw from Queensland University of Technology. They analysed historical data of Brisbane, and this is data from the 80s where the Brisbane airport, it underwent a change and there was a new flight path. So some of the suburbs in Brisbane were negatively affected by that new flight path, and they found that they had inferior growth for a period of around about 4 years after the flight path changed. But then after that and into the future, it was business as usual, and the performance of those markets matched that of Greater Brisbane. So even when you do have some of this negative infrastructure, depending on what it is, it could only be relatively short term. But that's just something that you've got to be aware of, and you look at infrastructure.gov.au and check out what's going on.
Well, you just, I guess, as an investor, when you're outlaying that type of money, you just go a little bit further in, wouldn't you? You wouldn't want to go close to the highway. You'd try and get away from that sort of noise if you can. That's what I'd be looking for.
Yeah. All right. Moving on, let's talk about environmental risk.
Yeah, I think this is an interesting one. So I guess properties located in areas so it could be like, bushfires is a big one. So I guess the south coast of Sydney got hit pretty hard a couple of years ago. So again, with a lot of bushland around, cyclones and potentially floods could have that risk on those locations. So I guess a way to maybe mitigate that is, Google Maps, just see what's sort of around, but also contacting maybe two different insurers, get some quotes just so you understand what are the premiums like, and if they are high, why.
Yeah, it's good advice. All right, what about market sentiment?
Yeah, so I think maybe the investor or whenever you're purchasing a property, the perception of a location could contribute to the area. So like positive news or developments could potentially drive values up, while I guess negative sentiments could decrease in value.
But it's odd. The historical data suggests that a high crime rate is not actually a negative for a suburb's future growth prospects.
Yeah.
But yeah, I think the market sentiment, when you hear sort of negative news, I think that's all very short term anyway.
It's just the media, isn't it? Really can.
Yeah.
There's a new area, it's done this much growth, but that growth can be very misleading. Oh, this area's had 50% growth, but it's a greenfield estate.
Yeah, and sometimes that can be just new properties versus old properties they're selling. It could just be an anomaly in the change in median.
Yeah.
All right, let's move on to actual property risks. So the address itself.
Yeah, so I'd say maybe like poor asset selection is most probably one. So just ensuring that you get that land content, the building in pest also is really crucial there. So
Mm.
You can get these building and pest reports, but sometimes they can be quite overwhelming. So it might be worth just calling up, or I'd call up the building and pest inspector to say, look, are there any major issues that you can see? So I think you can sort of mitigate that risk there. But also, if it is an older property, you can sort of fix it up a little bit so to potentially delay any further costs down the track.
Yeah,
So it
yeah,
could,
you got to jump on some things really quickly. Things like water damage, you got to block that leak so things don't get worse. Obviously, termites. You'd hope that you can avoid that sort of stuff up front. But another thing is body corporate.
yeah, so it could maybe include like maybe the voting. You don't really have control too much potentially. So an example could be you're maybe in a gated estate and you've only got maybe one vote, but someone else might own several properties in that complex that might have a bit more of that power. So it's just something to
Yeah,
consider. But ideally, you want to, like, as an investor, I think you'd want to stay away from a lot of those body corps. You want to try and buy a
a
house somewhere
house. Yeah,
with that land content.
yeah, that's right. Yeah, single title sort of mitigates that risk, doesn't
Yeah,
it?
because the thing is, land, I guess, appreciates and that asset depreciates over time.
Yeah, the building depreciates. All right, what about tenant risk?
Tenant risk, I'd say maybe potentially like vacancy risk or that negative cash flow risk. So I guess the way that you can maybe mitigate that is, look at the DSR. You can, extract the data and just ensure that, I guess, not in that specific suburb, but you can look at all those surrounding suburbs to look at the vacancy rate, just to ensure are there any outliers there. So, ensuring that vacancy rate is low.
Yeah, and another thing is that if you're an investor and you buy a property with a tenant already fitted, then you need to make sure you ask for the rental history to check for maybe problems with late payments, and maybe even ask the property manager if they would have any hesitation writing up a good referral for that tenant.
Yeah.
That's one mistake I've made in the past.
Yeah.
Yeah, research the property in the area well, but it's got a tenant already in it, and I just didn't bother to ask, and they turned into the nightmare tenant.
I guess another one just is maybe like property management risk.
Yeah,
Because I remember,
yeah.
I've had an experience before where, 2 or 3 property managers, and it took forever to get the property tenanted, just
Right.
because they promised me the world, but I wasn't hearing a word from them, which is
Yeah.
quite frustrating because you're busy with your life, and then you get a message saying, "Oh, congratulations! You've had 0 people come through your property this week." I'm like, okay, so it didn't feel great at the time. So it's just something to be aware of. To
Yeah,
do
it's
your
interesting because I view in property investing as I'm running an accommodation business and I own the business, but I've got an employee that is the property manager. So would you interview your property manager like you would interview a potential employee? I just think you got to put some effort in there.
Definitely, and it's for the long term too, isn't it?
Yeah, that's right. Although I have noticed property managers, I mean, it's not the nicest job. You do find a high turnover there,
Yeah.
so you probably want a good agency that hires good people. But in the end, it comes down to the individual.
And the other one, I guess, on that tenant risk, just to close that up, is maybe repair risk. And I guess that comes down to the tenant. Are they looking after the property? Yeah.
Yeah, all right. Okay, another one that we've got jotted down here, financial risks or leverage risks.
Yeah. So I guess in the planning days, like dealing with, over 500 clients, building plans, laying everything out, the money management is really crucial, but obviously that leverage risk. So, what's your LVR at? But more importantly, what's your surplus cash flow? Money coming in, money coming out, and what are you building those offset accounts up by? Is it $1,000 a month? Is it $5,000 a month? And the risk there is, again, with clients in the past, went quite aggressive. So they might have 1 or 2 properties in their portfolio. Then where do they go for that third one? A lender potentially like Pepper. So because they're very good on serviceability, they're willing to lend that money to purchase that property. And now what's happened is with these rising interest rates, they've got that monopoly where they've got these clients and they can up those interest rates to maybe 8, 9, 10% because they know people can't move.
Yeah, that happened to me actually when the GFC hit. I had interest rates go up to 11.5%. It was the only lender that would touch me, and there was nowhere else to go. So yeah, if you are looking for the absolute best lender, if you are pushing the margins of serviceability, and you've only got one lender that'll touch you, then they've got you over a barrel.
Exactly. So it's just to be aware of that risk. So you don't want to be going super aggressive if you don't have those buffers in place. So either have a fair bit of cash in that offset account, and then also if you've got like a share portfolio, if you are running those offset balances low, that you can potentially offset or sell down some
Dip
shares
into,
within 3 days. They're in your offset account. So you just want to make sure that you've always got those buffers
yeah.
in place. So crucial. That's pretty much my number one thing before you think about property investing. What's your lifestyle like, and what's your buffers have you got in place?
Right, yeah. Okay, so that's a good segue into planning risk.
Yes,
So this is all about money management, isn't it?
It's all about money management. So again, cash buffers, and how is this next property going to impact, I guess, your lifestyle or your cash flow? So an example would be, let's say you're saving $3,000 per month, and you've got good serviceability, so you can obviously work out what the yield of that property is going to be. You factor in all your buffers, maybe higher interest rates, maybe 92% occupancy rate, like whatever it might be. But do your analysis to go, okay, well, if I buy this property, it's negatively geared. It might cost me $1,000 after that benefit to hold. So my cash flows have gone from $3,000 I'm saving per month, maybe down to $2,000 now. So again, it's just how aggressive do you want to go? And I don't think you need these. Look, there are circumstances where it's good to get a plan done, but like these 40, 50, 60-year plans can be expensive. And do you really need it? Like, you really have to think to yourself, keep your buffers. If you're good, get good with your money management, and just focus on buying a really good quality asset, and just understand how that's going to impact your cash flows, and keep those buffers in place. So things like potential job loss. So if you're working and you're noticing there's a lot of redundancies in the company that you're working for, you just want to make sure that you're safeguarded there, because your job could be at risk.
Yeah.
Could be like things like you're planning a holiday, any family planning, maybe a new car, private schooling for kids, etc. So anything that you can sort of foresee major happening in the future, you just need to be aware of that, because you don't want to go buy a property, you've only got $20,000 in the bank, and then you lose your job, or you know that you want to get married, or you've got a big holiday coming up and you're depleting those cash reserves.
Yeah, and I think that the Earth seems to be spinning faster nowadays. Everything changes so rapidly. Whatever you plan, that's like 30 years into the future. I mean, everything's going to change there, and you can review that more frequently. I think it's important to have at least some plan for some years, but maybe you don't have to think everything through until the day you die. On the other hand, there are circumstances like if you're planning to have kids, you can't change your mind once you've had them. You can't put them back. So,
well, yeah. And I guess it's like you might move to 3 days a week potentially. So the partner might take maternity leave for 12 months, and then you will go back to 2 to 3 days a week. So that's going to impact your cash flows. So you have to do a bit of planning there to make sure that if you are going to buy a property and you're doing family planning, it's going to have a significant impact on your cash flow. So it really just depends on your risk profile. And job security is the big one.
All right. Last one, advice risk.
Yes. So, there's a lot of planners, I guess, financial planners out there, property planners, and you need to ask for, I guess, experience here is a key thing. But you also need to, I guess, connect with the advisor that you're dealing with. So, really ensuring that they've got your best interests on hand here. So, asking questions like, have you got a portfolio? How many clients have you worked with? Do you have any financial education? Because anyone can go into, like, I guess, a property planning role without any experience, and they can put a suit on and go, yep, this property is for you, without even knowing any of your goals, any of your circumstances, any of that. So that is major risk. Back in the day too, I've seen a lot of clients who'd come to me and, they've seen other property companies out there, firms, a lot of financial planners, and they've been burnt. Not to say they're all bad. There's a lot of good ones out there, but you have to be aware of the dangerous ones. So
Yeah, yeah. I've been burnt myself when I was a noob investor, and probably the biggest mistake I've made was assuming that this person I'm receiving advice from is an expert, and as it turned out, they were just they thought they were an expert, but they had no idea what they were doing. And I think there are a lot of well-meaning people out there who also have no idea what they're doing. They think they do, and then there are others who have just spent their whole careers promoting themselves as experts. It's just a marketing PR exercise, and they just haven't spent that time trying to become an expert, learning to be an expert. So, yeah, this one can really cost you. And there was a question that I know you ask all the time, which is,
I'm trying to think of it now. What is
how
it?
do you get paid?
Ah,
How do you get
yes,
paid?
yes,
There's
that was
so
on my.
many cunning ways in which people make money out of property investors, and yeah, it can really be a red flag how they get paid, because there can be property developers. They're getting very cunning at masking themselves as property developers.
Well, they're going to give you a report where it's like, 7% growth, and you're expecting that. They're like, this property, this is what we expect, but it's pretty much marketing, isn't it? I remember I had a client a while ago that used a financial planner externally, and then they set up a self-managed super fund, bought, I think, 2 properties, maybe in Rockhampton, land and house, and they did nothing. I think he bought one in his personal name and one in his super fund. And his super fund took a big hit. Even his personal, in his personal name also took a hit. Lucky he had 1 or 2 other decent quality assets that sort of negated that. But this is someone paying a professional, trusting them, and getting burnt.
Yeah, and they pay a big fee,
And there's
quite
no
often
repercussion
too. Yeah,
for
no
it.
repercussion. And another one that I've noticed. Well, there's 2 things I want to touch on here. First of all, is I've noticed that if the professional or their enterprise has a serious slant towards marketing, if they've come from perhaps a PR or marketing sales background, then they tend to lead with that skill rather than the actual product or service being offered. And quite often the second thing that I see is, here's where we bought for Jane and John, and it's had this sort of growth over the last however many years. And that is probably the exception. It's not the average. It's not the norm. So one of the questions that I'd habitually ask is, can you show us your past performance? And not just the best separated from the rest. I want to know what's average, what's typical, what can I expect? What can if I am a random investor who chooses your services, what am I likely to see? And if people can't provide that sort of past performance history, or they're reluctant to, then that to me is a big red flag.
Well, I'm not aware of any companies that actually are open with that. Like if I'm going to a buyer's agent firm, the first thing I'll be asking is what's your performance been over since inception?
Yeah.
Like show me that. And are they beating the national average? If you're paying this fee, are they? And I think there are a lot of good companies out there that do, but then there's a lot of other ones that don't, and they hide it with their marketing.
Yeah, there's a lot of skeletons in closet. I think there are a lot of well-meaning people out there, but there's a lot of misinformation too that you got to wade through.
Yeah, and the thing is, it's like I think back to that point we said, how are they getting paid? They're rushing to get plans out the door. Are they motivated by commissions? Are buyers agents there just to try and get a deal done and move on to the next client?
Turnover.
So just make sure, I guess, if you are dealing with a buyer's agent, just don't feel rushed in any way and ask a lot of questions.
Yeah.
Have your questions ready to go.
Ooh, I just thought of another risk.
Yeah. Before we jump onto that, let me finish this bit. So I guess I guess one advisor compared to another advisor can give a different opinion. So let's say I've got a property, 10 years, it's done 0 growth or it's gone backwards. One advisor might say, just hold it long term, never sell a property. But then it's an opportunity cost, where another advisor might do a lot of analysis around that and recommend a sell recommendation based on numbers, research, and data.
Yeah, that was the one I was going to bring up there, that opportunity risk. Yeah, that's a good one. All right. Well, I don't have any more. Have you got any on your list? I think that's it.
No, I think the only thing I was going to say was also, I guess, in the future, if you are going aggressive buying these investment properties and you're feeling rushed, always think, well, you're planning on buying a principal place of residence. You don't want to go out there, get over leveraged, buy all these investments, and then go, oh, 1 year time, we want to start a family, we want to buy our own
Mm,
house. You haven't had enough time for those investment properties to grow, to liquidate. So again, just be mindful of always forward think 3 to 5 years. Um, what's your plan? And finish up on, I guess, procrastination or that opportunity risk. So, as I said, never feel rushed. Don't think it's too late. You've got no properties. You're missing on this growth cycle. Um, don't feel pressured into
yeah.
buying right away because I've seen clients go, I feel like um, I've waited for too long. I just had to buy. But then they've gone and bought off the plan somewhere or bought a really poor quality asset instead of just sort of sitting down, planning it out, talking to a couple firms, or just doing their own research before purchasing a really good quality asset because, it's really hard to sort of buy, sell. And I actually had a client in New York. So New York, and he invested off the plan in West Footscray in the flood of units, had negative growth. In the end, he ended up selling that property, looking to sort of buy a really good quality asset somewhere else in Australia. So he just felt like he had to do something, bought
Mm.
a really good, poor quality asset. So again, just be aware of that.
Yeah, it's an interesting balance you got there. You procrastinate too much, and then eventually you're going to rush.
Yep.
So both of them are issues.
All
All right.
right.
Well, they say property investing is as safe as houses, but as you can see, it's not without any risk. But the good news is there are plenty of ways that you can limit that risk.
Yeah, great. Well,
Cool.
thanks for your time. And everyone, thanks for listening. Stay updated with our property insights and content. You know what to do. We'll see you in our next episode.